Hello everyone, this is Terry with Futures.io, and it's my pleasure to welcome back FuturesTrader71 for today's extended Ask Me Anything webinar. If you have a question during the webinar, please type it into the questions box and we'll do our best to answer them throughout the event. Also, if you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And without further delay, I will hand it over to FT71. All right, you should get the pop-up.
Okay, got it. Very cool.
All right, looking good.
Okay, good afternoon, everyone. Just to get started, a quick background. I've been working with FuturesIO for a long time, since they were Big Mike even, and Big Mike is a friend of mine, and I'm always honored when I'm asked to come in and share with you guys. I want to give a quick background so you know who's talking to you. My background is 100% professional trading. Been a professional trader for 17 years. I started as an equities, a high frequency equities trader, manual trader, and I switched to futures in 2002, and I have not traded equities. I've invested in equities, but have not traded equities since. My approach started out as high speed or high volume scalping in a prop shop, and then I owned my own prop shop, and I took on and trained traders, experienced at first, and then I stopped hiring experienced traders, and I moved on to training traders who have never traded before. I found them to be easier or can be turned more quickly. And since then, in 2010, I came or 2008 or something, I came online, and I started to discover that there's a huge information gap online, and I've been participating with the online community for a while now. So that's what brings me here. I just wanted to make sure you had the context of, if you don't know me, that you had the context of what my background is.
Okay, are you ready for questions?
Go for it.
All right, can you explain the trader draw drag and what is good and bad? It's in the stage 5 analyzer.
Trader draw. So the trader draw is in the trade analyzer, and I don't have it open, but let me see if I can pop in real quick and get that. It really is I believe that's the drawdown statistic. So here's the S5 trader analyzer. By the way, derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. So when I'm talking about performance, it is hypothetical. In most cases, just make sure you do your own homework. So let me try to find somewhere in this video the historical trade analyzer. Here we go. So I believe what this person's asking about is, let me see, the draw is just the draw. It's in this period, like in this example, from March 20th to the 24th. This is a live account for a trader here that we're looking at. This example, it basically shows you what the max drawdown is. Max drawdown is for this trader. And the reason I use draw and gain is I don't want to use loss in statistics. It has a negative connotation for most people, so we call it a draw. So the average draw when this person's losing, the average loss is 32 ticks. The stats here are in ticks, and the average gain is 31.25 ticks. 50-50 trader, which tells you that they are basically, unless they're holding on to a couple of really 50-50 long short, and then their win percent is listed up here at 66%. Their loss is 16.67%. The difference are scratch trades, and that's really what the draw is. That's what that's for. Okay, I think that answers that question.
Okay, let's see. Do you ever trade right off of key levels such as the overnight high, low, previous VPOC, or do you always wait for a continuation pattern?
No, I trade off of those levels. The approach for me, this is my ES chart here. It seems noisy, but I just have these levels on here. The key for me is here's the thing. What is a level, right? A level is just an area with where the market participation either dried up or there was a lot of it. Like in the example of a point of control, today's point of control is right up here at 2465 today. That level is created because you have to have volume profiling to see that. That level is created because a lot of traders traded there. And then you have the more easily discernible levels are low volume nodes. These are areas the market rejected. We could see a couple of low volume nodes in this composite. This composite is made up of everything that happened from the drop last week on the North Korean news on the 29th in the rally to the most recent high of 2479.75. And I'm creating a profile to see exactly where areas of acceptance and rejection have occurred in this rally, right? So as we dropped yesterday, I'm immediately creating this composite because the market's turning on itself now. So I'm trying to see, my goal here is to see what areas have been accepted or rejected. That's what at its most basic core, that's what support and resistance is. These are areas where the market is accepting levels and is supporting the movement, like support is beneath us, resistance is above us, or these are areas the market's rejecting and therefore we end up with these gaps. We end up with a push through a level, pull back to it, and a continuation. That level does not have any volume. So for me, I don't just put bids and offers out there at all these levels. Otherwise, I'd be trading every single point, every handle in the ES, or every couple of ticks in crude. What I'm doing is I'm looking for what is the market condition currently? Is the market trending? Is it seeking? Is it in a price discovery mode? That's another word for trend. It's a more descriptive way of calling trend. The market drops to find buyers. The market rallies to find sellers. As soon as it does, it finds that opposing force, and then it starts to balance out until the next rotation. And so my approach is to create a plan for if the market drops, what are the areas it is likely to test and what are the areas that are likely to hold. But I don't go out there and put bids and offers everywhere and wait for them to get hit. I don't trade that way. I've found that in order for you to trade that way, you need either a sizable account or a really high risk tolerance with a small account. And I have no tolerance for risk. I have little tolerance for risk. If I'm going to take 1 unit of risk, it has to be worth something on the upside. And I back that up with the auction, with studying the auction, and with statistics. So to me, for example, today the target above was 2468.75. This point of control you see right here, this black line that was formed of all days, as I described from last week, the beginning of the rally. And look at the high, the 2469. That's today's high. That's not something I cherry picked. It is what it is. And so for me, do I put an order out there? I expect the market to push through here and initially find some resistance. This morning, for those of you who watched the Trader Bite, I talked about the potential for the market dropping into this 57.50 to 56.50 area for support. The market turned before that. As the market turns early, then I start to participate. As the market turns early or hits that level and starts to fail, then I participate. And so I'm taking price risk there for a little bit more information. Not a lot of information, just a little bit of information. And I couple that with how the order flow goes, and then I enter. So my method of trading is not one where I've got bids and offers all over the place and I'm managing orders. I'm not managing orders, I'm managing trades. There's nothing wrong with approaching the market in terms of managing orders, but I would prefer not to take any heat if I can help it. And if the trade shows me that it's wrong quickly, I'm more than happy to exit and re-enter in the same direction if it starts to play out, okay?
Okay. How do you deal with squeeze? Too many times price stops me out and then follows my direction. Do you anticipate that with logic, or is it something that sometimes happens?
Well, there are two answers to that. One, it happens, okay? And squeeze is much easier in a thinner product like crude, NASDAQ, Russell, DAX, sometimes Dow, things like that. But if you find that quite often you are getting squeezed out of a position, chances are you are trading too tight. So for your particular product, you've got to find out, for your particular product and your particular time frame, you've got to find out what is, I've talked about this for years, what is the harmonic rotation of your particular product? And my way of finding that out is I've got a chart for it that was created by a gentleman named Hampton, so I have to give him credit for it. But it's looking at fractal rotations. So this is more statistics. And to be frank with you, the market's full of numbers, and if you're not trading with statistics, you're trading with statistics one way or the other. This chart basically looks at every single rotation. That's what these numbers are for. It's telling me what every single rotation is. So here this is for crude. Crude pushed 22 cents up, and it marks a dot right here, 22 cents. It gives us a dot. It's a move up, so it's a positive move. So it goes in this middle pane. Down moves go in this lower pane. And then what this is saying is, here's a 22 tick move in crude, and we're gonna mark it. And what this chart does is it accumulates all those marks, and it creates a histogram, a statistical histogram. And when we take the first standard deviation of the histogram right here, it tells us, so right there dynamically in real-time basis, and I'm using 19 sessions, I'm using a 1-minute bar chart, and I'm creating rotations using 5 bars. So the software is going to look 2 bars in the past, 2 bars forward, and if the current bar has the highest high, it's going to mark that high. Okay, and it does the same thing for the bottom, and that's what's called a fractal bar high or fractal bar low. And what this does is it accumulates all of these rotations. So for positive rotations, it accumulates all of them, and it gives me a volume profile. It's just a standard. If you remember statistics in college or in high school, this is what you are doing. You are taking data points and you're plotting a histogram. And then the first standard deviation of a histogram is what we call the normal population. That's when you say this kid's shoe size is normal, it means that that kid's shoe size for his age or her age is within the first standard deviation, okay? So that's 1 sigma. So what this says is upward rotations in crude on a 1-minute time frame, looking 20 sessions back, and it doesn't vary that much. You can go 200 sessions back. Is about 11 ticks. And if you're trading crude, let's just use this as an example. You're trading crude and you're short, okay? And then you put your order in and it fills it, and then the market pushes, 7, 8 ticks against you from the low to the high. It pushes 7, 8 ticks, and then you end up closing the position, and then you watch the market drop. What you did just there is you're traded inside of the harmonic rotation. You're trading inside of what is a normal rotation. So trading crude, your stop needs to be at least above 11 ticks, at least, if you're trading in a 1-minute time frame. If you increase the time frame, it gets even bigger because it takes more time for a rotation to complete, so the market travels a lot more. Okay, so that's most of the time that is the issue. So if you're being squeezed, your timing's wrong, your stop's too tight, right? Your time frame may be wrong for your account size. You may be trading a $4,000 account size on a 15-minute bar chart. Very tough to do. You have to be very, very precise, and it's hard to be precise in a market where the outcomes are random. The most common rotation in crude is 5 ticks, but that includes all the noise in the overnight session. And that's why I'm jumping to 11 ticks in this example. But if I switch it to just the pit session, this will move up a little bit. I think it's around 9 ticks and so on. And I have this for every product. So I can take this chart, type in another product, and change the parameters a little bit, and it'll give me what the harmonic rotation is. If you're trading inside of a harmonic rotation, chances are you're getting squeezed, and that's what you may be experiencing. The bottom line, either your time frame or your stop is too tight for what you're trading. That's what causes these regular squeezes. Now, do I get squeezed even with a 17 tick stop? Of course, because every once in a while the market might move 23, 25, 28, 30 points, 30 ticks. And there's nothing I can do about that. That's why we use, that's why we obey our stops or obey our risk. It's just nothing that you can control. But if it's something that happens on a regular basis, then it's cause for alarm, because you're just giving away, it's death by 1,000 cuts type of trading, which we see a lot. Okay, hope that helps.
Perfect, thank you. For the ES, what news sources do you watch during the pre-market, and do you watch news during the trading session?
My news is always on. I use the service called Trade the News. You can find that here. I believe you can find it. I think there's a deal on it on the Stage 5 website. So if you go to Stage 5, and the only reason I talk about Stage 5 is because that's a company that I helped build, and I know what's being offered. I'm not trying to promote them, but this is what I use, so I'm telling you what to use. So if you go to stage5trading.com and look for Trade the News, you will see a page for that. Now, you can take a 7-day sample, but I have the news running all the time. Now, do I trade off of every bit of news that comes along? I do not, but I like to know which moves are technical and which moves are news-based, because they behave differently. But I don't try to trade, the non-farm payroll release or, events like that. There are machines that are way too fast. But I like to know how far off the number is, so I get every scheduled piece of news on the second, so I get it immediately. And all I'm interested in is how far is it from expectations. That's all. It doesn't tell me whether the market will rise or fall, but it helps educate me on how far the market is likely to move because of how far that number is from the expectations. And that's mainly what I use it for. So if you look at the Trade the News site, you'll see some things highlighted here. These are expected to be market movers. These are potential market movers. Vice Chair Fisher, and so on and so forth. But other than that, trading news items is a difficult thing. But I'm not paying. I believe the service is $120 a month. I'm not paying that so I can predict the market or beat the machines. I'm paying that amount so that I can be informed as to what is going on, like yesterday's North Korea news that caused the ES to drop. When I hear the news and nothing happens for a few seconds and then the market starts to quickly drop, I know that this is a news-based move and it's likely to be extended, so I can potentially take advantage of that, okay? And lately, news has been dominant. I mean, today has been quiet, but I tell you, for the last week or so, a couple of weeks, it's everything that's said tends to make the market jitter a little bit. Okay.
Okay. In the past, prop traders used to use order flow on a dome. Why is it harder to use order flow now? Is it because of the algos?
Yeah, I tell you, there are clean markets still. So I preloaded today's today's session here into my S5 bookmap, and in the past, so the CME decided, I believe in 2005, to break up actual trades. So in the past, you look at these orders and you see 1s, 34, 90. Let's pause this a second. So you see that 90 there selling. Actually, let's go to a buy side. That's 61 right there. This may have been part of a 100 lot trade, but the way the CME reports it now is if somebody hits the market or lifts the market, in this case they're buying, this is right at 9 o'clock, the market buys and it wants to buy 100. Now what the CME does, what the matching engine does, is it reports to us how that 100 was filled. It reports the fill side. Okay, before 2005, you saw the demand side. So you saw 100 lot hitting the tape. And in fact, on the right platform, you can see which firm that order came from. 990 was Gelber, King Street had a different code, Citadel had a code, and you could see who you're trading against. All of that went away. So if somebody comes in and hits the market with a 1500 lot, the order flow will show 1500 contracts printed on the screen. It is hard to ignore that. And generally, depending on how it gets responded to, is it fully filled and the market doesn't budge, which means there's a bigger buyer out there that's underneath, that's not shown, which tells you there's potentially support there. Or if the 1500 goes and then you suddenly see the market depth clear out a little bit, try to hit the market as quickly as possible, because chances are you're going to get follow through on that 1500 lot seller. Now that 1500 will just rip across the screen as 1 lots and 2 lots and 5 lots and 9 lots and 60 lots and 20 lots and 30 lots, because that 1500 is being, it's being filled by so many different other participants, and they're reporting the individual fills of those participants. That's what makes order flow different today than it used to be. Now there are exchanges where the order flow hasn't changed that dramatically, like Eurex still reports the demand side instead of the supply side. But there are also tools over time that have come across that help, like this jigsaw trading tools and things like that, that help you analyze this. Now separate the order flow from the depth. Okay, the depth of market has always been fake. It's just because I have an order out there doesn't mean I really want to trade. And so don't confuse the depth with the order flow. So this tool here shows the order flow in terms of dots. So each one of these dots is a fill. So you can see down here at the bottom of the screen, bottom left of the screen, as I'm scrolling through, it'll tell you the volume of each fill. Like you can zoom all the way in here, and I can see this particular fill was a 3 lot. This particular fill was a 1 lot, and so on. That's the what's actually traded. That's the order flow. And then on top of that, what you have, these gray and white areas, are the depth, and that's showing you what the depth flow is, what the market's pretending to want to trade, and that helps out a little bit. To me, this tool has been absolutely instrumental. It's much easier to explain market movement using this tool, because you're seeing what's happening in the past, and these people are innovators of this tool. So I love to support them, but do you need this to be able to make money? You do not. Do you need to understand order flow to make money? You do not. Does it help? Absolutely, because at some point, even if you're a weekly trader, at some point you need to interact with the market. Your interaction with the market shows up on this chart. And the reason I look at this is because I want to see what areas, how the order flow is, how the depth is responding to the order flow, and it helps me locate my trades a little bit better. It helps me see in real time, without any delay, it helps me see what areas I can lean against to get the best possible fill for my plan. So I make a plan first. I have a bias. I want to engage with the market, long or short. I know the area I want to do it in. Now I'm simply using this tool. I place my orders on it, and I sit here, and if I want to buy, I go and place my order. And if I want to sell, I go and place my order over here. And I'm interacting with the market right on top of, let's get rid of these candlesticks. I'm interacting with the market right where it's at. I don't have to switch, I don't have to change views. I don't have to look at something different. It's all right here, okay? So I hope that answers your question there with regards to order flow.
All right, let's see. Regarding volume profile, when does the current day profile, the developing profile, takes over? When does it become more important than the previous day and overnight profile?
Good point. So as you can imagine, as the day develops, so let's create a profile as it's being generated. So let's see. Oh, that's interesting. I did not want that. I just put on a profile here that's exactly the same as the one that's already there. As the day progresses, let's delete that. As the day progresses, the profile for the session starts to form. It starts to show us what, here I'll draw it. So for the first, couple of minutes, the profile looks like that. Let's color that in so you can see it a little bit better. So this, so far, this is what the session looks like. So here we just opened. The profile doesn't look very useful. Let me expand this a bit. And so when does this profile really tell you anything? In my opinion, it's telling you something right away. So as you see the market expanding downwards, you see how the profile starting to fill up, see how it's filling up between this point and this point. It's telling you a little bit of something. But the levels on the profile, like the value area and the point of control and stuff, they're really not very meaningful at this point. There's very little volume that has gone through. So far we've traded 13 minutes into the session. The volume for the session is only 97,820 contracts. And the point of control is going to shift all over the place. Where the developing profile becomes useful to me, certainly. 1 second while I clear my throat here. Sorry about that. Where the developing profile starts to become valuable to me is after the initial balance is in, meaning 1 hour after the open. That's the initial balance. The high of the first hour and the low of the first hour, those create these solid lines, these yellow lines at the top and bottom. And at this point, I'm starting to pay attention. So if you look at how this profile goes, you could see that the market is really exploring higher, right? Most of the volume is occurring above the point of control. And so what we have here is a market that's eagerly exploring higher. Now the market has shifted, once we put in the high at 67, the point of control has shifted, and we're approaching that 1 hour mark. The market has shifted. Now I want to see, does it shift back? Oh, there's interest. So the market tried to bring balance back, balance up to 24.6750, which is the opening print today. And then as soon as it dropped, it brought that balance back down. This is likely to continue lower. This is information that is quite useful because it helps you see where are we versus the most traded price of the session. So you're constantly drawing a comparison between what are we doing right now versus yesterday. So that's here. Let me mark this up. So this is yesterday's profile right here. That profile is not going to change this session. It is done. This is the current profile right here. What are prices doing versus yesterday's auction? We've tested above this low volume node and below this low volume node. We opened right in this area right here. We can see acceptance yesterday was right there for this area. Does it move through the low volume node and start exploring higher and hold this area and start, engaging up here? Or does it fail back down? Oh, it failed back down. It tested the low volume node on the other side, on the dot almost right there. Now the question is, does it go back to the middle and get stuck in the middle to build energy for the next exploration, right? It's like, think of a crew climbing the Himalayas, right? You can't climb the Himalayas in one big hike. You have to set up base camp, and you have to set up camp all the way through, and you have to refuel and recharge and protect yourself. That's what the market does. It doesn't sprint. It kind of explores, then it rotates, and then it explores, and that's, the next big move up. Then it finds the opposite side, then it rotates, and then we decide, do we want to go down, do we want to go up? And it just does this on every time frame, all day and all night. And so that's, that developing profile gives us an idea of where things are progressing versus what's happened so far. See how the market expands lower? We see, okay, does it start to build lower? Do we go back to the point of control? The market likes to go back to the point of control very often and recheck it. So the developing point of control is as a point of reference that I like to use just as an idea of, if I'm long, say I have a reason to get long, I can predict that once we get to the 62.75 point of control, we're likely to get tangled up here. This is the most traded price of the day. This is the price that has the highest committed traders in it, or the highest committed volume in it by today's participants. It is very significant because these people are, they either win or lose depending on how the market moves versus their current position. And that is the highest number of participants. Do I need to know who is long and who is short at this price? I don't really care. All I care about is there are a lot of people up there that are long or short, and so we're likely to see a reaction. So every time we push into that point of control, remember it was right here, every time we push in, we find ourselves getting tangled for a little bit. Oftentimes it is resistance from below, support from above. Doesn't mean that it'll hold, it doesn't mean that it won't run through, but it very often behaves as a kind of a I call it my webinars on my website, I call it tall grass for a golf ball. It's not an area that a golf ball would just bounce through because it's taller grass. It's likely to get tangled in there, lose a lot of its energy in there. And that's really the extent to which I use the developing profile until later in the session. The profile also tells me what kind of trading has occurred. Like at the end of the day, one of the things I observe, and I note it in the trader bite when it's significant, I observe what shape profile do we have. Does this look like a balanced profile to you? No, it's not. There's a lot that happened here at 65. 65 has been a key area for a long time. There's a lot that's happened at 65, but today the market spent a lot of its time exploring prices up and down. It didn't really have consensus. Same thing as yesterday, okay? This is what the market looks like when it's in balance. Here's a little bit of balance. We haven't had true balance for a while. There's a little bit of balance there. You see that the profile gets really thick and fat and bulky. That's balance, and we like to see that because it helps predict the next big move that occurs after it. That's how daily profiles work.
Okay, let's see. How do you use opening swing high and low after the first 10 minutes?
So there's no time limit on this. I'm sure, Terry, by now you've heard this kind of question a lot every time I come on. There's no time limit or a period in which the opening swing high and low are created. The opening swing high and low, for those who don't know, it is the first high and the first low, clear low. Like today we had a beautiful swing high, swing low. That sets these lines up. So I immediately put those lines on there. I shift them from the prior day to the current session. And what those lines tell me is, as the market opened, where the higher participants, so we're always tracking, we're not tracking each other. Like, I'm not interested in tracking what the day traders are doing, right? I'm interested in tracking what the OTF is doing, the higher time frame, the Goldman Sachs's and the banks and the Fed and all these guys. When they're participating in the market, I want to see what they're doing, and they leave very distinct tracks behind. And so when those participants interact with the market in general, a lot of the, when somebody who's a end of day trader, what they're doing is they're looking at what has the market done today. They're working from a time frame that is much different than mine. What have we done for the day? Let's see, day chart. It's somewhere hidden in here. So this is a day chart here, okay? And so they're looking at what the market is doing from day to day. And oftentimes these guys are placing their orders at night or pre-market before going to work or whatever. It doesn't make a difference to them one way or another. A 10-point range for the day, it's not that big a deal, right, in general. And so a lot of that business is market on open, MOO orders. They're market on open orders. It's very often vigorous. And with the market opening, the first participants, just think of those Black Friday sales that we have here in the United States that are just notorious, where they film at Walmart all these people standing outside, right? Because they want to catch that sale on the big LCD screen that's being sold for 70% off. And you see these people, they're not walking in, they're not taking their time, they're not browsing, they're rushing in and they're grabbing the inventory that they want, right? People are trampling each other and pushing each other and things like that. Take that image, and it occurs in the market electronically every morning. The markets have become more of a 24-hour cycle versus when the pit was much more active, but we still have this limitation on the equities, the indices, where the underlying stocks that you're trading against or hedging against or speculating against have a distinct start and stop time. So this phenomenon still exists. And so there's a rush to participate right off the open, and what the opening swing is doing is it's measuring how far that participation got. So today's participation, we opened at 64.75. That was the opening print right on the dot, and we could only push to 66.25. That's only 1.5 points. That's 6 ticks. We got as far as 6 ticks before sellers stepped in. So we found sellers at 66.25, and then the market starts to shift down, and then it stops. It's just like boom, machine switches off. Why does that machine switch off? I don't really know, but I know that someone participated on the sell side, and they probably got done at this point, and now the market's sitting there. And then as it rotates back up, it tells me we have defined our high on the open, on the market on open orders. We have defined the low on our market on open orders, and those are the opening swing high and low. And then how the market trades around those all day gives me an idea. If the market crisscrosses the opening swing back and forth, chances are that that's one of the earlier indications that the market is likely to trade in balance. Like today, the market broke the opening swing high, the opening swing low. It broke the initial bounce low, the first hour, this yellow line, the first hour's high and low. So it broke the initial bounce low, it broke the initial bounce high, and where did it finish? It finished right on the point of control, right on top of the mid of the session, halfway point in the session. This is by all definitions, this is a market that's in balance. And what the opening swing tells me early on is if we crisscross that opening swing and just keep smashing through it, it's telling me to avoid taking any continuation trades from the center out. Well, what I also call inside out trading. So if normally I would get, I would see that there's a huge impulse here, and I would look for the short for the continuation, which worked today. Here's the impulse down. There's the mid short, classic setup for me for a continuation. So I'm looking for a break of 61.25. It ended up going to 58.5. And then we start to push back in to the opening swing again. I'm pretty tentative with these. I see that there's another mid setup, might take that, but I'm not gonna have as strong a position taking that short again. We keep trampling over the opening swing, and it's likely to trade to the other side. There's a probability of it trading to the other side. This probability was accomplished early on in the situation because it did so early. But if the market, say, opens and it trends, now I'm giving you a lot of information here, I know, but let's forget that the market rallied here. Let's say it moved down, then up, consolidated, and it moved down. And so the opening swing high is still intact. This doesn't exist. And then the market starts to pull back, and now we have the mid here. Now this is a solid trade for me. I'm looking for that short against the opening swing low, and I'm looking for a continuation. The market pushes back, puts in a higher low, and it starts to breach the opening swing low, and I see a reason to get short. I will pass on that because the market is back where it started this morning. I'm not interested in fading that market. Chances are it's going to go to the other side. There's a probability on a day where the high is not broken and we hold the low on a retest and then we enter the opening swing. There's an 80-ish% probability that we would hit the other side. Anyway, I might be confusing you more than helping you, but that's the logic behind the opening swing and why it's something I post on Twitter. Okay.
Okay. Can you provide some guidance on expectancy? What would be the minimum needed to switch from sim to live? And what are your thoughts on the subject?
Okay, that's a really good question. Now we're talking about performance, which is an area that just it's incredible how few people really talk about performance. And I think it's having been involved with a brokerage and being on the inside with the trade analyzer and actually seeing how people perform, I can tell you that it's probably because people don't track their performance that they hardly ever ask about it or talk about it. Now that question tells me that this person is tracking their performance, right? And so let's go back to the trade analyzer. One of the things it's tracking is expectancy. This number is very, very important because it's essentially an average, right? Expectancy or expected value in statistics is basically the win percent. In this case, we take an average times the average gain, okay, 31 ticks, minus the loss percent, which is also kind of an average, minus the average times the average draw. And in this case, for this particular trader, Daniel, it's 3.88. What that means is that if I was an algo, if I was an investor investing in an algorithm, and I knew that this algorithm had an expected value of 3.88 ticks per trade, then I have a pretty decent chance of making money. Now, the question is, how much expectancy should I have in sim before I try to go live? So the caveat to answering that is, how did you get that expectancy? If, for example, in sim, depending on which simulator you use, like let's say it's a TradeStation simulator or a NinjaTrader simulator or something like that, there's no algorithm within those particular simulators that that proxies or pretends to be a matching engine. It's basically filling you as soon as the price is touched. So if you trade in a way that says, okay, I'm going to risk 8 ticks and I'm going to target 8 ticks and I'm going to trade a 1 lot. And every time the market touches 8 ticks, you get filled, and now you have an expectancy of 1 tick. I'm going to say that you're not ready to go live. Why? Because in real life, you're not going to get that 8 tick exit. You're going to get the 8 tick stop. You know, in the ES and in a thinner product, it'll be worse than that because of slippage, because they're so thin. But you're not going to get the 8 ticks. Now, if we give up the 8th tick and really you're only getting 7 ticks, then the 1 tick expectancy is 0, and then you're basically just going to be losing your commissions and expenses. So you need to, the first thing you need to do if you're in a simulator is to penalize your limit orders. It's very important that if your plan says, I'm going to trade 1 contract, I'm going to have an 8 tick stop and an 8 tick target, and that's all I'm going to do. I'm going to be a binary trader, and that's what my plan is. Then what you have to do when you're accumulating your data, you have to, even though your plan is for 8 ticks of a target, you have to put your target out at 9 ticks. You have to guarantee that the market traded through 8 ticks to give you your fill live. Now that's one aspect, that's a technical aspect. The second and much more important aspect is the psychological aspect. So pretty much everyone here, if put on a simulator with a very simple plan, like I can sit here and say, I want you to sell the first touch of the opening swing under XYZ conditions, and all you do is sit there and just stare at the screen and just do it, chances are there's an edge in there somewhere, okay? And most people can make money on a simulator, and they might have an expectancy of 15 ticks, but somehow when they go live, that expectancy is negative. It just dissolves. And that's the psychological side. That's the side I talk about in webinar 3 on my website. I've talked about a lot on FuturesIO webinars. Like watch the one that's called, I think, the Holy Grail or something. That's a much bigger problem. And if you're coming into the market from sim to live for the first time, you really need a high expectancy. So live, if you get a tick and a half expectancy or better, like for my traders, a tick and a half expectancy or better for the ES, a point or so for the DAX, about 2 ticks for the Dow, 2.5 ticks for the NASDAQ, and so on. You know, if they have that, I'm pressing them to increase their size. That's the next thing we want to work on. So that's live. But if you're going from simulator to live, you need to push your expectancy much higher. So this person here on my screen, this is a live example on Game Futures, and their expectancy is fairly high. Their statistics are really decent. Their BSO is 100%. You know, they're getting fills. They're getting filled on their scale out all the time. This is a person I'm going to be pushing to increase their size. I'm going to be like, hey, Daniel, let's start. You're doing great. You're probably going from stage 2 to stage 3 of competence in trading. Let's push the size and see what happens with your overall statistics. We want to create a bigger return. But if you're going from sim to live, I think you need to see that under no psychological pressure, no error. You know, when we're psychologically pressured, when we're stressed, we introduce a lot of error. That's how accidents happen and things like that. And that eats into your expectancy a lot. You start to not believe what you're doing. You start to doubt. You start to fade your plan, meaning trading the opposite side of what your plan says. You start to do things. And I know a lot of you in here are probably going to say, I am really disciplined. You know, I joined the Marine Corps and I'm a soldier, and trust me, nothing tests you like trading does, because it's your money, and money makes us do weird things. So I've had people say, no, I'm not worried about discipline. You know, I'm going to go from sim. I don't need to be on sim long. I want to go live right away. And my answer is always, and this happened to every single one of the traders I back, my answer is, you don't know yourself. You're about to learn, and I'm going to be paying the price of you learning as someone who's working for me, but you don't know yourself. And so understand that when you go from sim to live, your errors are going to increase. You're likely to tamper and micromanage trades. You're likely to just, take the tick profit that you just saw. You don't want to take the drawdown. You want to take the tick and secure it because you want to feel better, and you start to trade your feelings instead of your plan, and that expectancy just goes south very quickly. So in order to prove your concept in a simulator, I suggest you try to get your expectancy as high as you can get it. Pick a number. 3 ticks. 3 ticks represents $37.50 per trade. That's pretty good for the ES. And then in time, what your goal is to trade a 20 lot, a 30 lot, a 40 lot, and a 50 lot, and so on. That's our goal. Our goal is not to get more ticks per trade on average. Our goal is to get a consistent number of ticks per trade, and then to accelerate our quantity, to increase our quantity, and use the leverage that we have available to us in futures, which could also be very harmful. But we want to accelerate our leverage to now make big dollars. And if we're not managing it, we lose big dollars. But that's the approach, okay? I know that's a long answer, but this is a really important thing for those who are working through their struggle and are looking for how to move to live and consistently build on the live side of their development.
Okay. There's a person asking, they have a $50,000 account. What would be the best time frame and an ideal product for them to trade?
That's also a great question. So $50,000. At $50,000, and assuming, so there are a lot of missing information there. Things like, what is your risk tolerance? What happens to the $50,000 if it's zero? Does it impact your lifestyle? In other words, is this real risk capital? Is your net worth 50 million and 50,000 is something you would spend on a weekend in Vegas? So you would trade a little bit differently because your risk tolerance is much, much higher in that case. But let's look at it this way. If you're going to trade futures, your best friend is going to be the margin requirement. That's the thing you should be using, in my opinion, as the brakes or the way to manage how much you put on. Just because you have 50,000, there are clearing firms out there, and I completely disagree with them, and those who know me know that I've been a very, very strong advocate of getting rid of $500 or $400 margins. I think they destroy traders' ability to give themselves enough time to actually grow into becoming a trader. Go full margin. Even though you're a day trader, go full margin. So on ES, that's $4,800 or so. And you can find that information on the CME. Okay, so you can go to the CME and decide, oh well, I want to trade crude or whatever. You can go to the CME website and find out what the margin requirements are. So here you can go and say crude. There's crude oil futures. Okay, margins. Okay, and it tells you what your maintenance margin is. Initial margin is 110% of maintenance margin. Okay, and so that's what you would use as a limit as to how much you should trade. As far as time frame, it just depends on what your perspective is. What is the what is your holding period? What are you comfortable with? Are you okay with a 10 or 15 or 20 point drawdown? These are all personal things. We're all built differently. If you're someone who's really attached to winning, if you're someone who's very much needs to be validated by your performance, by making money, like money makes or breaks who you are, chances are you want to reduce your time frame because you want to reduce the amount of time you have negative exposure to the market. Whereas if you're someone who's very much able to practice detachment, able to exercise discipline and so on, you can probably, with 50,000, use a higher time frame. You may also be open to trading options. Again, there's additional risk to trading with options, but you may be able to use spreads and thereby define your risk reward and things like that. There's a lot you can do with 50,000. This question is a lot harder to answer when somebody says, if you had $2,000 and you want to trade, what would you do with it? My answer usually is simulate the heck out of, simulate for as long as it takes for you to have more than $2,000 to make more money, to be able to deposit more money to learn from. In the end, we're here to perform professionally in a job that could be devastating financially in terms of risk and loss, right? If you don't manage risk and so on. So you need to be aware of that. But also extremely rewarding, right? With the leverage available in futures, it is, again, not suitable for everybody, but with the leverage available in futures, with the diversity in the markets that we can trade, with the tax treatment here in the US, the fact that these markets run 24/7, pretty much 24/6, 24 hours, 6 days a week, pretty much. You know, there's a lot of opportunity here, and that's why when I switched to futures, I didn't go back to stocks. I'm not at the mercy of the CFO of a company, you know, turning out to be a fraud, and then all of a sudden my stock is tumbling or whatever. It's much more macro in its behavior when it comes to futures. So 50,000 is a very, you know, when I came online, my initial recommendation for the minimum amount to trade with was $25,000. If you plan to do this professionally, $25,000, and expect to lose 20 of those. You know, as someone who's following a discipline and is not throwing money away, expect to lose about 20 grand of that, and expect to give yourself probably a couple of years in a non-professional environment and maybe a year in a professional environment to actually start to gain the skill set needed to be consistent in trading. I know my answers have been lengthy, but it's more important for me to give you quality and more complete information rather than snippets.
Okay, we're getting close to the hour, so I'm going to make this the last question. I think it should be a pretty good one. Can you give us an example on a chart of what you mean when you say aim small, miss small? It's tricky because when I think about it, it's hard to link that with let your profit run.
So aim small, miss small. This is something I think we talked about on Futures.io before. It comes from a movie called The Patriot with Mel Gibson, and it's an old saying that people in the military used to use, and what it means is if in a military perspective, if you have a target, if you have a person that you're shooting at, if you're shooting at the person in general, so you're shooting at this big blob of a person, then your shot may not hit them because you don't have a specific target. But if you see something like in the case of a movie, a button on the guy's shirt, you know, and you aim for the button, just your focus is directed and is deliberate on that button, then chances are, even if you miss the button, you'll miss small, meaning you'll hit the person in their core, versus, hey, I'm just going to shoot at someone's head or someone's body in general. In trading, it simply means, yes, I would love to come on here and BS you all day and say, oh yeah, I totally saw this low at 48.50, so I bought 48.75. and I got out at 68.75, and therefore I caught 11 points for the day. That is awesome. It sells books, it sells chat rooms, it sells courses and things like that. But what you'll see sitting next to professional traders is that they are much more they're aiming small. So even if you catch this move, as a professional trader, you're very often getting in, then getting out, then getting in, getting out, getting in. And what you're doing by doing this is you're aiming small. You're keeping the targets small so that you're capturing something consistently for your effort. And it allows you to be nimble, and it allows you to be active as opposed to passive in the markets. And this is how I trade. My goal is to come in and nibble away 2-point increments in the ES, 8 ticks or so in the DAX, about 9 ticks or so in crude. You know, that's my game. That's my sandbox that I play in, and I'm aiming small. And then that way, if the market continues, I have something on, and I keep campaigning, and I keep adding, and then taking another small target and another small target. The problem with a lot of people, like I've had many people write to me and say, I don't agree with your scale out scheme, because if I'm going to take the risk, you know, if I trade normally 2 contracts and I'm taking the risk of getting stopped out of 2 contracts, I want to get the benefit of exiting for 2 contracts. So if my aim is to have a 4-point stop and a 5-point target, you know, if I'm going to get stopped for 4 points and on 2 contracts, I want to get the target for 2 contracts at 5 points. I don't want to get in, scale out of 1 contract for 2 points, and then let the other one run for 5, you know, for 3 more. So now I'm risking, you know, 8 points to get 8 points or something. I want to get much more. And I'm going to tell you, realistically, that's very hard to do. It's much better to constantly focus on missing small. And that means keeping your risk not tight, meaning get in, and then if the market goes against you a tick, you close it and you pay all these fees and stuff, and you just bleed your account away. But to keep your targets small enough to justify a small enough amount of risk. And what that does is during the most active parts of the day, it keeps you hyper engaged with the market. It keeps you right on top of the market because you're constantly looking for fluctuations. So you may not be someone who's trading, I'm not talking about scalping here, by the way. You may be someone who's been waiting all day for this test of 58 even, okay? And you're looking to get long at 58 even. Even if you got long 58 even, you wouldn't get long 58 even for 3 ticks, although a lot of people do, and feel good about it, but overall their expectancy is going to suffer. What you can do is get long for 58 even. For 2 contracts, your risk is set. Take one off at 2 or 3 points. Now your entry on the second contract that's still on is much better. So now you've improved your theoretical average as opposed to the entry. Let's say entry's 58.5. You got filled miraculously at 61.5, and you had 2 on. So now automatically you get an automatic stop of 3 points below. So it becomes what, 55.5 becomes your theoretical average. That means if the market falls and touches 55.5 and triggers your stop, you will have broken even on the trade. And then you let the market do its pullback. You know you've got a lot of room, right? You could still get out. And then it starts to push. And as it starts to push, you basically are duplicating this entry again. You put another one on, and you're looking for another 2 points. Okay, you get that off, and now your original 1 lot that you started everything with is actually below 55. Your average is way down here, 53 or whatever. That's what we call the theoretical average. That's what I put on the trade analyzer as the theoretical average. It's also on Bookmap. Very important to know where that theoretical average is, because you're constantly aiming small and missing small. So if I put on a trade 1 out of 10 or 12, and if it's a busy day, 15 or 20 trades, and I lose 3 points here, a point there, 2 points there, maybe a 4-pointer here and there, I'm missing small because my aim is 2 to 3 points to 4 to 5 and so on. But if you come in and you have 1 setup a day, and that setup requires you to have an 8-point stop and an 8-point target, you're not aiming small. I'm not saying there's anything wrong with it. This is advice that I give for those who are inconsistent or those who are looking to kind of step in on the shallow end of the pool and are learning to swim. I'm not talking to divers here. So, you know, having the opportunity to, okay, I lost a 1.5 or 2 points on my first trade. There's still opportunity for me to capture another 2 points here, another 3 points there, 1.5 here, depending on the context of the market, as opposed to coming in with a plan, especially in this product that hasn't been moving very well for 2 years now, to come in and swing for the fences. I'm going to go for the full ATR in ES. I'm just going to go for 9 points. Well, what if you don't get 9 points? Well, you're missing big because you're aiming big. That's what that's about.
Awesome. Thank you for the information for the webinar, and most importantly, thank you for your time today.
I just want to finish up here, Terry. I always want to leave a nugget behind when I do these. This is a quote that I saw the other day by Michelangelo. It's so true for trading. You know, the greatest danger for most of us is not that our aim is too high and we miss it, but it is too low and we reach it. And I see this day in, day out from traders that I interact with, and I interact with a lot of traders, either by email or by watching their risk or whatever. I find that people are satisfied coming in, just watching the market for the day, maybe simming a little bit, maybe taking a live trade, maybe going back to sim. They're aiming too low and they're satisfied with it. And before you know it, they've been doing this for 5, 6 years with no consistency. And so this was very apropos, this quote here. Aim for something, aim high, set a goal that's just beyond your reach, you know, in terms of expectancy, or how many errors will I commit, how many errors will I cut down this week. Aim at something so you have a chance of hitting it. But if you come in and just kind of, you know, you're in the forums and you're in a chat room somewhere and you're just kind of dabbling and time passes by, you're satisfied by aiming low because it's an easy target to reach. You're coming in and you're reaching your target every day, and that gives you a sense of satisfaction, but you're not seeing any progress. So I want to invite you to start at least tomorrow, you know, starting tomorrow and going forward, to tell yourself before the day begins, yep, this is my plan for the day. If you have a plan, this is my plan for the day, but also here's this one thing that I'm going to aim for today, that I'm going to achieve. And if I don't achieve it, I'm coming back tomorrow and I'm going to hammer at it until I achieve it. This is how you start to see progress. This is what you're forced to do in a prop environment, which you don't do, or most people don't have to do because they don't have the pressure, you know, in their own home or in their own office or whatever. So I just want to invite you to start aiming for something. I think you'll be much, much happier with your progress. And this way, Futures.io and these webinars and stuff will make so much more sense to you because you're dealing with the issues that others are asking about. And it gives you a chance to ask questions that may be helpful to you. I appreciate your time, Terry, and sorry for keeping you an extra 8 minutes. Thanks everyone for giving me a chance to talk here.
It's all good, thank you.